So the valuation depends on the type of the bond that we are looking at. The type of the bond that we are looking at. Okay. So bonds could be irredeemable, redeemable, and convertible. But the concept is still the same. How do we find the value of all these? The answer is we simply discount. What we discount? We discount all the benefits. So basically, we discount all the benefits on the bond. What are these benefits on the bond? It's the interest amounts. Interest amounts. Okay. When the bond is still running, it's the interest amount. Then at the end, if the bond is redeemable, there's also a redemption amount. So the redemption amount, if the bond is redeemable, we're talking about it, the amount receivable on a redemption. If the bond is convertible, then you're talking about it, the conversion amount or conversion value. So basically, to find the value of a bond, to split market value of the bond, we discount all the benefits that are accrued to a particular bond, which is basically interest amounts. So if it's redeemable, it will just be interest through and through. If it's irredeemable, if the bond is redeemable, when it's running, the interest amounts, at the end, redemption amount. If it's convertible, we're talking about the interest amounts when it's running, and at the end, conversion value. Now, what do you use as a discount rate? If we're talking about discounting, we must talk about discount rate. What discount rate do you use? Now that is a question to you. What do we use as a discount rate?
We use the rate of return.
Rate of return. Okay.
The coupon rate.
The answer is here. The pre-tax cost of debt. The pre-tax cost of debt is what we use. Or another language, you can say, use your gross redemption yield. Gross redemption yield. Another term that we can use, we can simply say we use the investor required
return.
Return. You can use this also. Investor required rate of return, gross redemption use of it, cost of debt. Okay. So then, with that in mind, a question here. What is the current market value of land company, convertible or not? So we've got a question here. The current market value of the convertible or not? Land company has an issue, 3%. That's a coupon, convertible or not, are redeemable in 5 years. At the nominal value of 100, Alternatively, each loan can be converted in 5 years' time into 25 Len ordinary shares. The current share price is 3.6, and the future share price growth is expected to be 5%. The before tax cost of debt is 10%, and the corp tax is 30%. So with the perfect question here, remind us of how we're going to value this particular bond. So we need to find the amount, the benefits. What are the benefits? 3% every year for 5 years. So these are the benefits that we have. So in terms of the benefits, every year, we have got 3% on $100, so that's $3 per annum for 5 years. Then at the end, there are two things. Either you get the redemption amount of 100 or you get the conversion value. So which one is higher? Let's work out the conversion value. So in year 5, let's work out the conversion value. What's the conversion value? We've got shares. The current price is 3.6. Then multiply by 1.05. How many times? 5 times. That will give you the share price after 5 years. How many shares are you going to get? 25. Then multiply this by 25. Let's find the answer. So what is the answer now? What's the value of these shares?
$115.
115 something.
It's actually
114,
114.8.
86.86.
87.
Like that? So
Yes.
what we expect is that in year 5, the investor is going to convert. Okay. Now, let us conclude our work. So the $3 per year for 5 years is an annuity. So that one we're going to use an annuity factor. So then our value will be the $3 multiplied by the annuity factor at the rate there, 10%. So that's what you do here. Then you add the discount factor at 10% in year 5. Then you multiply this by 114.86. So then, can somebody give us some values here? What's the annuity factor at 10% for 5 years?
$3.791.
791.
So 3.791 plus then 114.8. What's the discount factor at 10% in year 5? 0.621.
621.
Okay. So what is the answer? Anyone with an answer?
$84.94.
80,
84.94.
84.94.
Yes.
$84.94.
I get 82.66.
Somebody gets something. What do you get? 82? Point
0.66.
0.66.
0.66. Okay. All right. So
Yes, that's correct.
could it be, so where is the rounding off coming from? Because the answer is clearly it's this one, eh? The answer is this one. So it could be rounded off here. Is it 87 here? Or 86 like that?
Yes, there it was 87.
87.
87.
87 or 86. Okay. Please, can you just try that? Make sure you get the actual number.
$2.71.
82.71. Okay, fine. So now we have got the exact answer, 82.71. So let's just go through what we have done again. Let's just repeat what we have done. Okay. How do you find the market value of a bond? You simply discount. You discount all the benefits. You find the present value of all the benefits. So like our bond here is a 3% bond, meaning that if you buy it, you're going to receive interest. So the benefit that we're talking about here is the interest. So the interest is what you are getting, which is 3% on 100 or $3 for 5 years. So this will be for 5 years. Okay. Then in year 5, there are 2 possibilities. In year 5, there are 2 possibilities. It's either you redeem and you're going to get 100. Or another possibility is that you convert and you get how much? 25 shares. So there are 2 possibilities. So we pick the higher possibility. So you people, you did the computation, you say, okay, when you convert, the share price in 5 years would have moved. It will be 3.6, 1.05 to the power 5. And that's where you ended up with the 114. Now, then you multiply this by 25. So you ended up with a value of 114.86 or 87. So that's what you found. Okay. So the benefit, so between these two, we went for the higher benefit. So then we discounted this as an annuity and this as a one-off cash flow. This is an annuity, this one was an annuity because it's a constant figure over 5 years every year, and this one is a one-off figure. So basically that's the principle that we have followed. Okay. The trick here we shared with you is that what are we supposed to use? Before tax cost of debt. Because these are market values. These are market values in an open market. So we calculate these values gross. We calculate these values gross. Let's revise another question. What if they ask you to find the floor value of this bond? What's the floor value of this bond? What's the floor value of this bond? Are you familiar with this concept, the floor value of the bond? What is the floor value of the bond? Floor value of the bond is a value calculated on the assumption that you are redeeming, that you're going to redeem at 100. So that's what we have, $100. So let's find the floor value. So floor value will be 3 multiplied by, what was the annuity factor again? What was our annuity factor?
3.791.
3.7 plus 100 multiplied by 0.621. So that is how you find the market value, the floor value of the bond. That's the lowest value. Why? Because the market value is below 100, then we put in 100. So the floor value or the lowest value of the bond. What is your answer here?
$73.47.
Now, I've seen multiple choice exams, what they do. This one also was there. Notice that. It was there as well. But we are looking at the market value and not the floor value. Okay. So if they say what is the floor value, that's what would have given. Eh? Okay, let's ask another question. What if the bond is irredeemable? If the bond is irredeemable, how do you find the value? If the bond is irredeemable, how do we find the value?
We use the cost of debt and deduct the tax from the cost of debt. And work out the IRR with the interpolation calculation. And then you ignore the current share price.
Okay. So if the bond is irredeemable, if the bond is irredeemable, the market value of the debt is, you take the interest then you divide by your pre-tax cost of debt. If the bond is irredeemable, you know about irredeemable bond. If the bond is irredeemable, what do? You take the interest amount, divide by the pre-tax cost of debt. Let's take note of that one. If the bond is redeemable, it's what we have done. Convertible, what we have done in this question. Is that okay? Okay, fine. If that is okay, let us discuss something here. Equity. How do we value shares? How do we value shares? We can do an asset-based valuation, market-based valuation, and capital-based valuation. Asset-based valuation. In an asset-based valuation, what do you do? Asset-based valuation. Asset-based valuation. You take your non-current asset. You take your current assets. You take your non-current liabilities, and current liabilities. Then you bring in your preference shares. So non-current asset, non-current liabilities, current liabilities. You knock off there. This is the value of equity. This is your value of equity. Okay. What values do you use here? In the absence of any information given, you just use the book values. But normally a question will combine. The question will combine, they will give us a combination. What do we mean when we say they give you a combination? Well, some values will be at book value. So we're going to be given a combination of a mix. So some items will be at book value, others will be at the realizable value. So what do? Wherever there is a realizable value, you replace the book value with the realizable value. Replace that book value with a realizable value. This method of valuing a company has got a problem. Why? because it's historical. It looks at the past. It looks at the past. That is where the problem is. When you're buying a business, are you buying history? You're buying the future. And most of these values may be outdated. Companies don't normally update these values. So you may find that the values that we are dealing with are outdated, meaning that we may undervalue the company. Also, most of the intangible assets are not normally captured here. So you find that in non-current assets, there's no intangible asset. That is another problem. Do you want to try out a question? Here's a question for you. Here's a question for you. Please, can you do a computation here? I'm going to pause it. The figures are here. Non-current assets is 30. Current asset is 18. Non-current liability is 12, and that is 10. The net realizable value of non-current asset exceeds the book by 4. So what did we say? Here, what do we put here? What do we put here? 34. The current asset includes accounts which are thought to be irrevocable, irrecoverable. So we go to non-current assets. We change that figure to what? To 16. Are we okay, people? So you've got 34
Yeah.
plus 16 minus 12 minus 10. What do we find here?
28.
28. 28. Now they say per share, 28 is total. Per share, how many shares do I have, people? Here, can somebody help me? How many shares do I have here?
2 million shares.
2 million shares.
2
Wow.
million shares.
Wow. Wow. What is the answer?
40.
Oh. I had how many people? Let me see how many I had. Only one. Clarice is the one who had 14. The rest had 28, 28, 28. And yes, and Collins also had 14. Have you seen how tricky it can be, people? Eh? Those are doing multiple choice. You see how tricky the exam can be. We walk out of the exam, we felt, yeah, this was very easy. Eh? I hope we have learned something, eh? We have learned how to find the value of equity using the asset method. Okay, good. Let's come to this one. A company has annual after-tax operating cash flows of 2 million per year, which are expected to continue in perpetuity forever. The company has a cost of equity of 10%, before cost of debt 5%, and the work of 8%. And the corporation tax is 20%. This question is very unfair. It's got a lot of irrelevant things. What is the theoretical value of the company? All you do is you discount this figure, which is after tax. You find the present value of this figure in perpetuity. And the operating profit. Do you remember operating profit? What it means? This is profit before interest and tax. Who are the owners of this money? Who own this money? Both the bondholders and the shareholders have a claim on this money because we have not removed anything for the bondholders. We have not removed anything for the shareholders. What does it mean? To find the value then, remember how to find the value of perpetuity? So you take your 2 million, then you divide by 8%. This money belongs to the shareholders and the bondholders. So the cost of capital that we must use here is a cost of capital which includes both the shareholders and the bondholders. And a figure which is in perpetuity, its value is equal to that figure divided by discount rate. So what you discount, when you divide, what do you get?
25.
25. Okay. So to find the value of the company in total, what do? You are discounting. What are you discounting? You are discounting the after tax operating cash flow. So it's the cash flow that you are discounting after tax. Okay, there we are, people. What of dividend valuation model? Let's talk about the dividend valuation model now in the DVM. How do you find the market value? Using dividend valuation model, DVM. If a dividend is constant, how do you find the value? If you have got constant dividend per annum, how do you find the value? That's what we do. What if the dividend is growing at a constant rate? A dividend growing at a constant rate. The share price is what? Over what? Minus? That's what you use. Dividend after 1 year divided by cost of equity minus the growth rate. So if you are going to use the cash flow methods, you can use the dividend growth model, where dividend is constant or is growing at a constant rate. What will be the market-based valuation? Market-based valuation. We can use a stock market variable. And mainly, which variable do we use? the share price equals PE multiplied by the EPS, or if it's in total, the value of equity in total is PE multiplied by PAT. Where do these values come from? Where do these values come from? Let's talk about these values. Where do you get this from? Where do you get this from? Industry average or a proxy company. What of this one? Where does it come from? The company that is being valued. The company that is being valued. The company that is being valued, that is the one that is going to supply. Or does this come from industry average? You can use an industry average, yeah? Or can use a proxy company. Is that okay? Okay, that is all right. Let's move. There is a small question here. There's a small question. Evaluate the effect on the wealth of the shareholders of the company of using net rights issue fund to redeem the loan notes. Should you make a rights issue of shares to pay off a loan? Is it acceptable to do so? Is it acceptable to use a loan, raise a loan, so to raise equity, to make a rights issue of shares, just to pay off a loan? Would you allow a company to do that? That's what this question is all about. Discuss whether the company might achieve its optimal capital structure following the rights issue. Optimal capital structure after the rights issue. Is it possible to reach that point? Okay, so let's look at this particular question. Let's look at this particular question. Why are we covering this question together with evaluation? There's an element of evaluation. So the first thing that we're going to do is we're going to calculate the rights issue. How much money will be raised from the rights issue, and then find the theoretical X rights price. Let's do that step by step. Let's do that step by step. Let's do that step by step. So we take that. Okay, so let's get started. So the first step in answering this question is to calculate the theoretical X rights price. That's the first step. The information is here. The company is planning to raise 11.2 through a rights issue. The new shares will be offered at a 20% discount. The current share price, which is 3, the rights issue will be 145, and the issue cost will be 280, will be paid out of the cash raised. So let's do the calculation. Step by step, then we can arrive at the advice. Current, new, and you've got your total there. Now, because of the issue costs, work on a total basis. How many shares has the company got currently? How many shares? Now you know, 10 divided by 0.5. That gives you how many shares?
20.
20, eh? If I throw away the 3, well, if I put all the zeros there, 1, 2, 3, 1, 2, 3, okay? How many new shares are going to issue? That divided by 1, by 5. So that's the number of shares that we have. The prices, 3.5, and this one at the discount, at a discount, what are the total amounts? Total amount, let's go, that by that. Okay, now they are saying that out of this amount, what's happening? The issue costs are 280. There's issue cost of 280. So I'll put in the issue costs. So what's the net? Okay, have we all followed that? Have we all followed that story there? Hmm? Have we all followed the story?
Yes, thank you.
The theoretical X rights price is that amount divided by that amount. So that is your step number one. Step number two now, let us say pay off the loans. Let us pay off the loans. Let's look at our loan. How much loan do we have? Your loan is here. It's 30 million. Okay. So let's follow the loan. Book value. The book value is 30 million. Okay. What over the market value? What's the market value? Just check what they're telling us here. They have given information. It's trading at 104. It's trading at 104. So let's go. You say not a problem. You say you take this figure, you divide by 100, multiplied by 104. So this is the market value. However, they say if you're going to redeem, you redeem at what? At a premium. Read this. You redeem at a premium. Premium of how much? 5% of the market price. So if you want to pay off this loan, what the bondholders are going to accept will be this figure, give them a 5%. So this is the trick that we had in this particular question. So if you are going to pay off, this is the amount that you must pay. Book value converted to market value converted to redemption amount. So this is the amount that you must pay. Now you, how much money do you have? How much have you raised? How much have you raised? Hmm?
80,920,000.
This is how much you have raised, because part of the money has gone to where? Part of the money has gone where? The issue costs. Part of the money has gone into the issue costs. So then from there, let's pay what we have. This is all we have. Let's make a payment. How much loan has remained? How much loan will remain? 21,840. This is the loan that has remained. This is the remaining loan. That's a balance. But this balance includes two items. Market is at the redemption amount. I want you to take it back to the book value. Let's take it to the back to the book value. So what do? Remember, you multiplied. Here you multiplied by what? 1.04. Then multiply by what? 1.05. That's what you did. To move from there to there, that's what you did. So all I'm saying is that you divide again by this and that to find the book value. So you take your figure, 21, 840, divided by 1.05, divided by 1.04. So you can give me the answer now. Can I have the answer?
20 minutes.
Mhm. Okay, so this is the book value of the bond. So all things being equal, your balance sheet will still show this amount. What have you achieved? You have reduced your loans. From what level? From 30 million, you have reduced from there to there. That's where you are. Now, is it good for you to raise money to pay off a loan like this? That's the question. Do you think it is good? What you're going to do is, here's how you answer the question. You say that all things being equal, that's the price that we expect. Now you're going to do evaluation to check what is the price. What method are you going to use? Now they have given you a clue here that what you do is use this information here. You're going to use this information. Have you seen this information? They are saying that the earnings per share currently, total earnings currently, that's where we are. And then they're giving you another clue. They say that the price earnings ratio will not change. Will not change after the redemption. So the first thing that you do is you calculate the price earnings ratio. That's what you're going to do. Please, can you find the price earnings ratio? Price earnings ratio, the share price divided by the EPS. So what's the share price currently for this company? 3 point. What is the EPS of the company? 0.42. So what is the current PE of the company? Can somebody divide, please? $3.5 divided by 0.42. What's the current PE?
8.33.
8.33. Now we are going to conclude our question. We are going to find what's the share price using this PE. Let's calculate the share price after the redemption has taken place. Let's calculate the share price. And this is why I brought this question. That is why I brought this question. Why I brought this question is for you to do a PE-based valuation. That's what I want you to do. A PE-based valuation. That is all I want you to do. So let's calculate our EPS. Good. Let's calculate our EPS. What is our EPS after the process? Let's calculate together. The earnings of the company is 84. Okay. Let's work out that. What do we mean by earnings? What does the figure earnings mean? That's your profit after tax. So you say, this is the current situation. Your profit after tax for this company is 84. That's what it is. Okay. Then they remove the tax here. What's the tax rate that they remove? Let's check. The tax is 30%. They remove tax at 30%. To arrive at 84. So what was the figure before tax? What was the figure before tax? I know you accountants are very good at grossing up. Let's gross up the values. Can somebody please gross up the value for us? This figure is after 30%. So let's gross it up. What was the figure here? Let's gross up. Divide by 0.7. So this was the figure before. I divided by 0.7. I've done cross multiplication. This figure was after remove 30%. So this figure was 70%. So what was 100%? Do cross multiplication. We do cross multiplication, we find that the figure was that amount there. How much interest was paid? How much interest was paid? We are paying interest here. It's here, you bond 8%. So we paid interest of 8% on 30. How much is 8% on 30 million? Can somebody give me the figure? 8% on 30.
324.
Yeah. Is it that figure there? So what was the profit before interest and tax? We just add back. So this was the profit before interest and tax. This was the interest. Then there was a tax here. That was a tax figure. So profit before interest and tax. And then you've got that figure there. That's what you have. So you have 8.4. Now, afterwards, what do we have? This will not change. It's still the same. We didn't expand this business. All the money went to paying off the loan. The interest has now changed. How much is your interest? We only have 20. That's a loan that has remained. So your interest has come down. And that is the reason what you're trying to do. You're trying to reduce the interest payable. You get the idea? You are paying a very huge interest amount. So what you are trying to do is pay off part of the loan. So now our interest has come down substantially. And how much tax are we paying? That's how much tax you're paying. So your profit after tax Your profit after tax now is that minus that. So this is your profit after tax. Now you can calculate our earnings per share. Let's calculate our earnings per share and conclude our case for today. So now we can calculate our earnings per share. How many shares do we have now? How many shares do we have? You have done your computation, which was properly done. How many shares do we have now? Here? 24 million.
24 million.
So you have got now your 8,960 divided by 24. So what is your earnings per share?
Lucky.
Earnings per share.
Apologize there too, Alex.
Earnings per share.
37.3.
This is my earnings per share.
That's
So after we've paid off a loan, our earnings per share will be 0.37. Finally, now, back to our valuation. Share price equals PE multiplied by EPS. Finally, then I can explain a little bit more what we have gone through. So the PE, they say it won't change. Remember what they say? They say the PE won't change. It will continue as 8.33. Then your EPS, you have just calculated that your EPS equals 0.37. So your share price in this case is 8.33 multiplied by 0.37. What is the answer now? What's the share price that we expect? What's the share price that we expect?
11.
Huh?
11.
Here we are. So what do we say now? Do you think this is acceptable to you? The question is back to you, the owner, the investors. Do you think the use of the money is acceptable? What we expected according to the, in theory, 3.37, this is what we know it should be. But after paying off a loan, we're ending up with 3.08. The use of the money to pay off loan is not acceptable. Why? Because the expected share price is below this figure there. So now let's go through the principles that we have covered here. This question has been examined not only once, but a number of times. What is the question? Is it acceptable to make a rights issue of shares to raise money to pay off a loan? So in your answer, step number 1, you must calculate the target, your standard. The standard is your theoretical X rights price. That's what you must do first. Calculate your theoretical X rights price. Back one. You calculate this. And you must say, this is my standard. This is what is acceptable to me. That's step number 1. This question has been repeated should we make a rights issue of shares to raise money to pay off a loan? Number one, calculate the theoretical exercise price. Number two, you come here and use the price earnings approach to find the share price. Use this approach. The only figure that will be missing that you have to calculate is this one, the EPS. That's the only figure which is missing, which we have calculated here after the rights issue, after paying off part of the loan. After paying off part of the loan, what happened? What was the idea? It was to reduce the interest payments. And that's what we can see here. The interest payments have been reduced. So this was the reason. Okay. Questions? Is there a point that you have missed in the process? Have we missed a step on the way? So remember, if you ask, is it acceptable to make a rights issue to pay off a loan? Calculate the theoretical exercise price, that's your benchmark. Then calculate the share price using the price earnings method. And in that method, you need two variables, the price earnings ratio, normal, which comes from the current situation, and the EPS from the revised situation. Okay, how is that? How is that? Okay, so the SK students, are you on leave now? Or you are still
Yes,
the SK students, are you on leave this week? Or you still go for work?
No, working still.
You are
Still
still
working.
till the last day.
Yes, including the last day.
Including the last day but work.
Right in the morning and then go back to work.
Wow, that's tough, eh? That's really, really tough. Oh,
Month-end reporting.
come again?
Month-end reporting.
Oh, month-end reporting, yes, yes.
Yeah.
I hear you, I hear you, I hear you.
Listed company requirements.
Yeah,
Tough.
yeah, that's true, that's true. Okay, no, that's true. Okay, fine. All right. And when is the paper? When I take your paper?
On Friday morning.
Or Friday morning, that's when you're taking your paper.
Yes, 9 in the morning.
Ah, okay, fine, fine, fine. Okay, no, that's understood. That's understood. Okay,
The pressure's on.
yeah. Okay, good. No, that is very much understood. Okay. Otherwise, if you people are available during the day, we could have put another hour or so. But that you're at work, it's understood. It's understood. Okay. Good. The CS students, when are you taking your exams again? Is it Friday? It's on a Friday next week?
Yes, Friday.
Friday next week.
Or you're taking your exam on a Friday next week? Okay, fine. Okay, so what I'll do is I'll just post on your forum our weekend activity when we practice some papers. I'm arranging some 4-part papers that we can practice over the weekend then. Eh? So I'll post everything on your forum. Eh? It looks like the network is Gift, are you able to hear me there?
Now we are.
Okay. All right. Okay, somebody has indicated that lunchtime, I'm available at lunchtime. There are some people available at lunchtime. Okay, between 12 and 14. Between 12 and 14, some people are available at lunchtime.
Yes.
Okay. All right, fine. Okay, so tomorrow at lunchtime then, tomorrow at lunchtime, I will meet the ACCA students. Eh? So ACCA students, CA, stay away tomorrow, but there's no harm if you log in. The ACCA students, please log in tomorrow. I see 12 to 14. 12 to 14. Please log in tomorrow at that time. Eh? Log in tomorrow at that time so that we can review 1 or 2 additional issues. Eh? Yeah. Okay. The CS students, I'll post your papers on the forum, which I'll be doing with you weekend and even in the course of the weekend. All right. Good people. Good night. Thank you.
Thank you.